If you have unlocked your phone at any point this week, or, caught even just 3 seconds of a financial news broadcast in the background of a coffee shop, you've already seen them.
Oh, yeah, the big flashing red arrows.
Exactly. The aggressive, panic-inducing headlines about market sell-offs, global conflicts, economic uncertainty. I mean, it is loud, it is visceral, and honestly, it is entirely engineered to make you click and keep you scrolling.
It really is. It's designed to trigger that fight or flight response.
Right. But that is exactly why we are here today. Welcome to today's deep dive. We have a very specific mission for you. We're going to cut right through that manufactured noise. We're unpacking the reality of this massive geopolitics-fueled market sell-off. We'll look at the immediate tangible shocks caused by global conflict, and then, and this is the important part, we're going to take a collective breath.
A much-needed breath.
Seriously, we are going to look at over 80 years of historical market data to figure out how you, as an informed investor, should actually react, because the data tells a very different story than the headlines.
Setting that baseline is so critical when we are dealing with this level of macroeconomic anxiety. When you log into your brokerage account and just see a sea of red, the immediate hardwired biological response is panic.
Oh, absolutely. Total panic.
But the entire architecture of our discussion today revolves around understanding the vital difference between short-term volatility and long-term compounding.
Yes.
We are diving into some very real, highly impactful numbers that look grim on the surface, but by mapping out the actual mechanics of this sell-off and comparing it to historical precedents, we can contextualize these momentary dips. They are ultimately just a single, highly volatile chapter in a much longer, mathematically encouraging story.
I love that framing. A single volatile chapter. So let's start by looking squarely at the chapter we are in right now, because the hard numbers driving this immediate shock are significant.
They definitely are.
The market just experienced an aggressive, oil-driven, geopolitics-fueled sell-off. We saw some incredibly deep intraday lows. And just to put a fine point on that for anyone who doesn't watch the ticker all day, an intraday low means the market opened, went into a steep free fall during trading hours, and managed to claw back some of those losses before the closing bell.
Right, a partial recovery before the day ends.
Exactly. But even with that partial retracement, the closing numbers still left a mark. The S&P 500 fell 0.95% to close at 6,816.59. The Nasdaq Composite lost 1.02%, settling at 22,516.69. And the Dow Jones Industrial Average slid 0.83% down to 48,801.28.
And the pain was absolutely global. It wasn't just isolated to the U.S. Over in South Korea, their benchmark stock index, the Kospi, took a massive 7% dive.
7%, that is a huge hit.
It is. But perhaps the most psychologically taxing metric for an investor looking at their portfolio this week is that the S&P 500 actually turned negative year to date.
Ouch. Yeah. Watching an entire year's worth of gradual gains just evaporate and flip into the red in a matter of days, that is a heavy blow.
It is a heavy blow, and to understand the velocity of that drop, we have to isolate the catalyst.
Yeah.
The geopolitical driver here is the escalating conflict involving the U.S., Israel, and Iran.
Right.
Just from a strictly impartial macroeconomic perspective, a conflict involving these specific actors is not a localized event. It sits directly on top of the nerve center of global energy markets. This is a systemic shock.
Because of the oil.
Exactly. The immediate consequence of tensions in this specific region is a rapid, violent surge in oil and gas prices. And energy is the foundational input for essentially everything in the modern global economy. But the issue extends far beyond just the spot price of a barrel of oil. This conflict is physically threatening global shipping lanes, specifically the Strait of Hormuz.
Which is one of the most critical maritime choke points on the planet. I mean, when you have an active conflict near a choke point like that, the logistical nightmare begins almost immediately.
Overnight.
Yeah, shipping insurance premiums skyrocket. Cargo ships literally have to be entirely rerouted around continents to avoid the risk zone, which adds weeks to transit times. Supply chains suddenly develop these massive bottlenecks.
And that logistical nightmare triggers a cascading economic threat. The broader fear sweeping through the equities market right now is that if this geopolitical conflict is prolonged, it acts as a massive, uncontrollable inflationary force.
Inflation loop.
Right. Think about the chain reaction. We have surging energy prices combined with supply chain bottlenecks. If it costs significantly more to fuel a factory and drastically more to ship the goods that factory produces, those costs are inevitably passed down the line to the consumer.
They always are.
Always. And that threatens to reignite inflation on a structural level. And if inflation reignites, central banks find themselves backed into a very uncomfortable corner. They cannot cut interest rates to stimulate the economy. In fact, they might be forced to push interest rates even higher to artificially cool demand.
So the anatomy of this sell-off is actually quite clear when you break it down. Conflict sparks an energy spike, which drives up shipping costs,
Right.
which threatens inflation, which raises the specter of higher interest rates, and higher interest rates fundamentally pressure stock valuations. That is the exact loop investors are pricing in right now.
You hit the nail on the head. That is the exact mechanism.
So when you lay out that inflation loop, it becomes really easy to see why different sectors of the market are reacting in wildly different ways. I mean, think of it like throwing a stone into a pond. A macro shock like this doesn't hit every company equally. The ripples affect different areas in different ways.
Yeah.
Capital immediately starts rotating out of vulnerable sectors and into defensive ones.
It's a flight to safety.
Exactly. And looking at the specific winners and losers in this environment is fascinating. For instance, energy-sensitive travel and the major U.S. airline carriers absolutely tanked during this sell-off.
The mechanism driving the airline sell-off is a perfect reflection of that inflation loop we just talked about. Airlines operate on notoriously tight margins that are intensely sensitive to two things: consumer demand and fuel prices. When oil surges due to the U.S. Israel-Iran conflict, jet fuel, which is often an airline's single largest operating expense, surges right along with it.
But it's worse than just the fuel price right now, isn't it?
It is a compounded issue for the major carriers right now. Middle East route disruptions are severely pressuring investor sentiment. These airlines are paying a premium to fuel the planes and simultaneously having to scramble to reroute international flights away from active conflict zones.
Right, which takes more time.
Exactly. Rerouting means longer flight times, which burns more of that wildly expensive jet fuel, all while carrying the exact same number of paying passengers. The margins simply collapse.
It is a brutal environment for commercial aviation right now. But the market isn't just a monolith of selling. We saw some very resilient stocks hold their ground while the rest of the market was bleeding. Berkshire Hathaway held up as a perceived defensive stalwart, a classic flight to safety asset.
Right.
But more specifically, the defense contractor Lockheed Martin showed incredible resilience. And the reason they weather this particular storm comes down to how investors anticipate government behavior during a crisis.
Precisely. The resilience in defense contractors is tied directly to heightened war-related spending expectations. When a geopolitical conflict escalates, particularly one involving the U.S. and its core allies, the market does not wait for the ink to dry on a new Pentagon budget.
No, capital moves instantly.
Instantaneously, investors immediately anticipate a long-term increase in government defense procurement and weapons replenishment. Companies like Lockheed Martin are structurally positioned as the primary recipients of that heightened spending.
So it's a massive divergence in sentiment.
Huge divergence. While the broader tech or consumer discretionary markets are rapidly pricing in the negative impacts of inflation and supply chain disruption, another subset of investors is simultaneously pricing in the expectation of massive multi-year government contracts for defense companies. It perfectly illustrates how macro events aggressively dictate capital flow on a sector-by-sector basis.
Okay, so if you are listening to this right now and you're staring at your retirement accounts, everything we just mapped out, surging oil, disrupted shipping lanes, major airlines tanking, a 7% drop in the Kospi, the S&P turning negative for the year. It is objectively anxiety-inducing.
Completely understandable.
The natural instinct is to liquidate, move to cash, and just wait for the dust to settle.
Yeah.
But here's where we introduce the ultimate antidote to that anxiety. We're going to zoom out. We're stepping away from this week's ticker tape, and we're looking at historical data.
This is the most crucial psychological pivot an investor can make. When you are standing in the middle of a market shock, the environment always feels entirely unprecedented. It feels like the specific geopolitical crisis of the day has broken the machine, and the market will never recover.
This time it's different.
Exactly, the most dangerous words in investing. But research from Detrick, the chief market strategist at Carson Group, provides an incredibly grounding reality check. He looked past the immediate, visceral panic of a sell-off and analyzed the hard data of how the U.S. market actually responds to massive crises over the long haul.
The scope of Detrick's study is what makes it so powerful. He didn't just look at the last 5 or 10 years. He analyzed 43 separate geopolitical and major historical events that the U.S. has faced from 1940 onward.
43 events.
We are talking about 43 massive historical shocks that spans over 80 years of wars, assassinations, global pandemics, financial meltdowns, oil embargoes. I mean, it is a massive sample size of the absolute worst news the world can generate. And the statistics he found regarding the market's reaction are completely counterintuitive to how we feel when we watch the news.
The data fundamentally challenges our panic response. Detrick found that just 6 months after these major historical crises began, the median return of the S&P 500 was actually positive.
Wow.
Specifically, a positive 5.3%.
That is a staggering metric.
It really is. Within half a year of a major world-altering geopolitical shock, the market had, on median, not just stabilized, but actively grown by over 5%. And the trend becomes even more compelling as you extend the timeline. In the full year following these major events, the market was higher 65% of the time.
Higher 65% of the time. Think about that. Despite facing 43 completely different, seemingly insurmountable global crises over 8 decades, the market essentially goes up 2 out of every 3 years.
It's remarkably consistent.
It is. And that statistic echoes a core philosophy from David Gardner, the co-founder of The Motley Fool. Detrick's 65% finding perfectly aligns with one of Gardner's self-evident truths of investing. He states it very simply. 2 years out of 3, the market rises.
Which brings us to the absolute most important takeaway for anyone trying to navigate today's market turbulence. You cannot let short-term volatility interrupt your long-term compounding.
Right.
It sounds like a simple aphorism, but it is an incredibly difficult psychological discipline to actually master in practice. When the S&P drops nearly a full % in a single afternoon, the overwhelming instinct is to stop the bleeding. You want to sell your positions and step away until things feel safe again.
Because it hurts to watch it drop.
Of course it hurts. But the data from those 43 historical events proves that interrupting your investment timeline because of a scary news cycle usually guarantees that you miss the recovery. The market grinds upward 2 out of every 3 years. By pulling your money out during a geopolitical shock, you are actively betting against an incredibly robust 80-year historical trend.
You are quite literally betting against the math. And the math says the optimal move is almost always to stay the course. Now, the logical conclusion for most people hearing that is to simply buy a broad index fund like the S&P 500, go to sleep, and wake up in 20 years.
The classic set it and forget it.
Exactly. And frankly, that is a highly effective strategy for building wealth. But the data analysis takes a fascinating contrarian pivot right here. Despite everything we just discussed about the undeniable resilience of the broader market, the Motley Fool's Stock Advisor analyst team recently compiled their list of the 10 best stocks for investors to buy right now, and the S&P 500 index did not make the cut.
It highlights a really crucial distinction in investment philosophy. We just established that the broader market is incredibly resilient and historically reliable. Indexing is the ultimate tool for capturing that baseline 65% win rate without having to do any heavy lifting.
Right.
But the analysts are outlining an entirely different strategy here. They are not looking to capture the market average. They are actively hunting for what are known as 10-baggers.
For anyone unfamiliar with the terminology, a 10-bagger is an individual stock that increases by 1,000% or more. We are talking about producing absolute monster returns that can fundamentally alter the trajectory of your entire portfolio.
Life-changing returns.
Truly. The argument is that while the S&P 500 is safe, it is essentially a weighted average of hundreds of companies. It is mathematically capped at providing the average return of the American economy. It's not designed to give you a 1,000% return on a single position.
Right. The math doesn't allow for it.
Exactly. To achieve those kinds of exponential gains, you have to transition from buying the whole haystack to hunting for the specific, highly disruptive, rapidly scaling individual companies before the rest of the market fully prices in their potential.
And tying this back to the geopolitical shock we discussed earlier, this is exactly why moments of extreme macro panic are so critical for this strategy.
Oh, this is the best part.
Right. When the entire market sells off, due to fear over the Middle East or inflation, the foundational index drops, but individual outlier companies also get dragged down with it. These moments of widespread red are historically the exact moments when future 10-bagger companies go on sale.
A discount on the future. And the historical examples of these 10-baggers are absolutely astounding. The Stock Advisor team has recommended over 35 different stocks that have eventually crossed that 1,000% threshold. Look at Netflix. They recommended Netflix back in 2004.
Wow, 2004.
Yeah. If you had invested $1,000 into Netflix at that time, That single position would be worth $523,599 today. $500,000 from a $1,000 flyer.
It is a phenomenal return, but we really have to contextualize what it actually takes to realize that gain. To turn $1,000 into $500,000 in Netflix, you had to hold that stock for 2 decades.
That is a lot of patience. But wait, look at NVIDIA. Everyone is chasing NVIDIA right now, but they made this list back in 2005. A $1,000 investment in NVIDIA in 2005 would be worth $118,640 today, well over $1 million.
Unbelievable.
They also highlight more recent momentum plays. Tesla, recommended in 2012, is up 18,901%. And CrowdStrike, which was only picked in 2020, has already climbed 301%.
Those numbers are staggering, but they require a completely different psychological framework than indexing. To get that $1.1 million out of NVIDIA, you had to buy it in 2005 and then do absolutely nothing while holding it through the 2008 global financial crisis.
Oh, man.
And the 2018 tech tantrum, the 2020 pandemic crash, the 2022 interest rate sell-off. You had to watch your portfolio value get cut in half, perhaps multiple times, and still refuse to hit the sell button.
That is the true cost of a 10-bagger.
Exactly. Synthesizing these two approaches really frames the ultimate choice an investor has to make. You have the historical data from the Carson Group proving the broader market's resilience recovering and rising 2 out of every 3 years despite global chaos. That is the safety of the average.
Right.
On the other hand, you have the high-reward pursuit of individual outlier companies requiring an iron stomach to hold specific stocks through their own unique volatility, knowing that just 1 or 2 massive winners can completely transform your net worth.
It is the comfort of the reliable 2/3 average contrasted against the extraordinary life-changing potential of finding the rare outlier. It is a fascinating choice to weigh, especially when the market is actively testing your nerves like it is this week.
It really is the ultimate test.
Well, let's recap the ground we covered today. We started right in the middle of the anxiety, looking at an aggressive, oil-driven sell-off tied directly to severe U.S. Israel-Iran conflicts. We mapped the very real economic mechanics of that shock. How surging energy disrupts shipping in the Strait of Hormuz, threatening a loop of inflation and higher interest rates. We saw exactly how that scenario crushes airline margins while funneling capital into defense contractors like Lockheed Martin. But then we zoomed out. We looked at 80 years of hard data encompassing 43 major historical and geopolitical shocks since 1940. And the math proved that despite how terrifying the news cycle feels, the market is historically robust.
Incredibly robust.
It delivers positive median returns just 6 months after a crisis and rises 2 out of every 3 years. We established that the single greatest risk to your wealth is letting short-term panic interrupt long-term compounding. And finally, we explored how you can leverage that long-term patience, whether you choose to ride the reliable wave of the broader index or hunt for those elusive 1,000% outlier stocks during a market panic.
As we wrap up this analysis, there is a lingering thought worth considering next time you open your phone. We now have 80 years of empirical data showing that 43 major geopolitical shocks have almost consistently been followed by a market recovery within a single year.
Yes.
If that is the mathematical reality of the stock market, what does that say about the entire ecosystem of daily financial news? Are the flashing red arrows, the breaking news alerts, and the panic-inducing headlines actually providing actionable intelligence? Or are they fundamentally just psychological noise, perfectly engineered to distract you from the quiet, boring, but incredibly lucrative reality of long-term compounding?
That is exactly the question you should be asking yourself the next time a headline tries to scare you out of your positions. Thank you for taking this deep dive with us today. We appreciate you trusting us to help cut through the noise and find the signal. Stay curious, stay disciplined, and happy compounding.